And welcome to another edition of the Nerdy Agent Podcast. I'm your host, Luke Pettersen, with my brothers and fellow nerds, Josh and AJ. Today, we'll be diving into the changes happening to the FHA Mortgage Insurance Premium rates for 2023. Specifically, I think it's March 20 and beyond. Mm-hmm. But first, the Would You Rather of the week. For you guys. Josh wanted to point. We don't point anymore, but Josh wanted to. Would you rather have a pool or a hot tub?
Well, beforehand, I point because I'm very routinized. Like, my whole life is a routine, so it's very difficult for me to just get out of this routine.
That's a great word.
Is
word
routinized a word?
Of course.
We're going to have Haley double check that.
If I'm wrong, there's no audio clip of me saying "of course" and guaranteeing that it's a word, but I'm 99% sure. I would rather have a pool. I'm deathly afraid of pools, so there's a part of me that's like, the thought of it, because I have young children, so pools scare me. But if I had a pool like my friend down the road has a pool that is killer pool with amazing landscaping, patio, a cover that you can stand on, like that, it's pretty awesome in the summers here.
Routinized is a word.
Oh, what's the definition of routinized?
Past tense, routinized. Past participle, routinized. Make something into a matter of routine subject to a routine.
How do you use routine?
And that's the
twice
definition
in
of
one
the day. It's definition of the day for you.
Super strange. Okay, anyway, I would choose a hot tub, I think.
For a pool?
I don't think I really want a pool in my backyard. I want grass.
This is a weird question because it's like a pool costs $150,000 and a hot tub costs like $10,000.
Yeah, but you got to maintain that sucker too.
Yeah,
I'm taking the money out of it. So like,
and I also am saying that we do have a friend down the street who has a pool that I can go to anytime.
If I could get a sweet sauna with the outdoor shower on it, I would take that over these two options.
I am choosing hot tub, and I'm also choosing that my neighbor has the coolest pool in the world. So then I can have my hot tub, then I can go to my neighbor's house for the pool. Because that's what AJ just did, apparently.
Also,
that's what we do.
When you say pools have a lot of maintenance, do hot tubs have a lot of maintenance, AJ and Luke?
No.
Not new
If
ones.
they break, you
Not
just
new
give them away.
If they break, you just spray foam them a couple more.
For anyone who doesn't know, they've both had hot tubs that have both broken. So
we will have another hot tub, though.
There you go. And not a pool.
No.
Yeah.
Let's get into FHA loans here. To start, I just want to give the listeners a basic rundown of what these are, how they differ specifically from other loans in the marketplace, namely the conventional loan.
Yeah, we did a whole episode on the different types of loans. So if you want like a thorough overview, you can go back to that episode. But FHA loans are similar to conventional loans from the borrower's point of view, right? If you have an FHA loan as a borrower, it's going to be very similar. You get a bank statement, you pay your mortgage, everything else like that. But the difference is FHA means Federal Housing Administration. They insure those loans versus conventional loans. And they are typically reserved for buyers with lower credit scores or lower income levels. They allow for higher DTIs. It goes up to like almost 57% on those. So if you need a higher DTI, sometimes that's a loan you can use. And credit scores into the 500s, which in conventional loans you wouldn't usually qualify. And then you can go as little as 3.5% down. So they allow you to be a lower down payment. You get them through FHA-approved lenders. So in a lot of ways, like I said, you can use the same lender that you use as an agent for your FHA loans as you use for conventional loans. The biggest difference is there's some additional rules. There's a more thorough appraisal inspection type deals. So if there's certain things, specifically like peeling paint gets called out on FHA loans a lot, whereas conventional loans, the appraisal component is more of a valuation than an actual like inspection. And then the PMI is the biggest piece, and I think we'll probably end up diving into that in a little bit here. But that is a higher rate typically for FHA loans than it would be for a conventional loan. And it also tends to survive the life of the loan. So those are two very important things. As you think about an FHA loan, the PMI was the biggest component that was almost making it less advantageous to use in the past. But there's been some changes.
Yeah, so you're talking about PMI is the biggest issue there. So essentially, just so they do know.
Or MIP, I guess.
MIA, it's called
FHA.
Mortgage Insurance Premium. If the listener doesn't know, on a conventional loan, when you do hit 20% equity in the house, the PMI falls off of the loan. Like you had said on FHA, it's always there unless you refinance into a conventional loan.
Yep.
That being said, though, affordability is at all-time lows. I mean, we have talked about this. We probably could do another podcast on the affordability index.
Yep.
And so what the government's actually doing, though, is implementing some new pricing for the loans that they can control, the FHA loans, to make them a little bit more affordable. So tell us about kind of what that's looking like and what they're rolling out.
Can we take a step back, though, and talk about like how funny it is that we've come to the point where FHA is only seen as low credit and high DTI.
Right.
It's kind of funny because like,
do you know why it started?
Yeah, because there was the stock market crash in 1929, and then there was World War II, and there was a lot of veterans coming home, and I think the VA came out around the same time,
maybe.
And but it was loans were only 20% down, right? Like, or even 50, I think.
It was a lot of private funding kind of deal with that, with high down payments.
Houses
That's why
were
they started.
$12,000.
And so the government was like, I mean, we've come to a point where the wealth gap in our country is huge, but it would have been significantly worse had this not have been implemented because normal people couldn't even buy a house. And so the government said, we should make it so normal people can buy houses. And it was a great GDP thing. It spurred the economy. They had to build a bunch of houses because people were no longer renters.
Yep.
And then I don't know when conventional decided they'd go lower. I think we've talked about this before, but maybe in the 70s or 80s or something.
We haven't. We should
definitely talk
history
about
of conventional loans.
But the government did this guinea pig thing for long enough, and they said, "Oh, these 3.5% down buyers are only defaulting at whatever rate. We should do lower down payments." So I'm sure they slowly worked their way down until they were like, "Well, we're at 5 or we're at 3.
Yeah.
We're even lower than
that's
FHA.
the funny one. That's came out only the last couple of years. The Home Possible loan at 3% down is even lower than the 3.5%.
Bell Bank does 1% down now on conventional loans.
That's crazy.
So the fact that we've come that far, I just think that's kind of funny. And now I think the government's trying to address some of that with what we're talking about today.
For sure, because some of the loan, that's the only thing you do run into these is the terms are not as good. So you can get a loan versus like the only reason you use FHA today basically is if you can't get a conventional loan or if it like doesn't make sense for the numbers.
Or multifamily in a certain situation.
Yeah, there's certain reasons for it, but yeah, it is an interesting point. I just never thought about the history of the competition that essentially created these different loan types and what we're using today. Good call.
So let's get into the pricing and the changes that are going into place.
Well, yeah. So the PMI was a 0.85% before, and now it's going to be 0.5%, 55%, I should say.
And that's of the loan amount.
Loan amount. And so what you're seeing is, like on a $250,000 loan, you're looking at $750 roughly of savings per year. Mm-hmm. So $62 a month. I mean, we could run these numbers through a mortgage calculator, but the affordability, you can probably afford $25,000, let's just say, more potentially.
Yep.
Just with this one change that's come into effect. So when is it? Is it in effect now, Luke, or is it?
I'm almost certain it's March 20.
March 20. Okay, we'll confirm that and get that onto the description here on this.
Luke's
podcast.
going to figure it out before the podcast.
He probably will. But I mean, you get up to $400,000 loan, FHA, you're saving $100 a month now. That's pretty significant. I mean, that's going to change the amount of money people can qualify for sure.
Yeah, absolutely.
So the one thing then, so we kind of you touched on the numbers there and how much people are going to save. I mean, even I'm looking at some of this, like up to on a $400K loan, it's $1,200 a year.
Yeah, $100 a month.
It's an extreme amount of money. So I just want to talk about what we think is then going to happen due to this in the real estate market. Because the unique part, right? I think it is cool that the government is trying to make loans more affordable for people that, are from a situation that's maybe a little bit tougher financially. But the weird thing is that especially in Minnesota, we already have a ton of buyers in the market and not enough houses for them.
And this is what they're doing with, we'll talk about in another podcast, but the conventional changes too are kind of geared towards, let's get, people that have lower credit scores or maybe a little bit less income into houses. But I think where you're going here, you can continue.
Before we jump into that though, should we talk a little bit about will FHA loans become more popular as a result?
Yeah, that's what I was getting
Got
to.
it. Okay, so I think that my plug on this one is we go back to this. Make sure you have a good lender, right? Most lenders should be gathering information from your buyers and then giving them options on what's the best decision for them. Mine, for example, does like a total cost analysis. So we'll be like, if you do 5%, here's this. If you do FHA, here's this. If you do 10% conventional, here's this. And then they give you essentially the whole life of the loan. Your monthly payment will be this. Your overall extra interest over the life loan will be this. So you can see your options and see kind of what works best for you in these different environments. So just a caveat, make sure you have someone who's thinking critically on behalf of your buyers on the lending side. But I do think, if the monthly payments are going to go down as a result of the MIP going down, which was the biggest reason why FHA loans weren't working historically for some buyers, I could see it being a more advantageous option than had been previously. There's a stigma about FHA loans a little bit in terms of the appraisals and people assume bad buyer quality when they see FHA. But the reality is if this changes the game and the landscape a little bit, it could be something that more buyers are just looking at as an option for them.
I think the other thing that could really affect this too is and again, like you had said, it's a holistic approach on what their actual situation is, their snapshot on who they are and what their credit is and what their down payment is, what their DTI is. But I was just looking up because I was curious, because FHA has their specific percent of the loan amount to create the MIP number per month, right? On a conventional loan, that's floating. So like the internet tells you it's between 0.22% or 2.25%.
Yeah, it's wild how wide that range
because
is.
if you have a bad credit score or not much money down, it can really swing that. And so the unique thing here is if you're dropping this 0.3%.
Have you ever been asked by a client, like, how much is PMI?
I say
and you're like
100 to 150.
I don't even know what your credit score is.
Yeah, it's like, it's so wide, the range.
But that's where I think, like, to your question on popularity, though, I think it's going to make sense more so for people to explore this if they have a 640 to a 680 credit score and they're looking at conventional and they're not going to live at the home forever necessarily because the
won't fall off at 20%.
Won't fall off at 20% down. So, like, if they're looking at a 5-year house and, you know, they're at a 655 credit score, they could go, well, my PMI is going to be at 400 is going to be, let's say, $250 or $300 a month at 5% down, and it's only $99 if I do FHA. So maybe I should consider this. I mean, that could be hundreds of dollars.
I bought my first house with FHA, but that was back before conventional loans went down as low as they could on the down payment percentage. So we bought it because it was the only one we can get for 3.5% down.
Josh,
and I was young and didn't have any money.
You're really aging yourself right now.
2008.
He also got paid by the government to buy a house.
I did, yeah.
That's cool. But I do think in some of those situations, when you're talking about 0.3% swing, there's that good likelihood that some people it's going to make significantly more sense for.
It might be cheaper.
Yeah, I mean, I guess we haven't deep dove like every scenario, like where that cutoff point is going to be. But I think the lenders, you know, have conversations with your lenders and say, like, which type of buyers is this now going to make sense for that it didn't make sense for before, right? So if they were a conventional 3% or conventional 5% that had a credit score in this range,
and they're still searching, they haven't found something yet.
It may change the game for them. So I would have those conversations.
Interesting. And so the other thing that I want to touch on here is this also not only will get somebody, let's just say, go from conventional to FHA, but you might now have somebody go in and go, well, I was FHA, but now my FHA approval is higher, right? And I have more buying power, or more people look at this and go, they can actually buy a house now because of that. How do you see, especially let's focus on the Twin Cities market, because I think right now there's a lot of differences between a lot of the different markets. How do you see that impacting our current situation?
I mean, you could say it's not going to be a massive amount of the market, I don't think, but it's probably going to move the needle a little bit into more demand and pushing the prices again higher. So what may end up happening is it may make it more unaffordable.
It's a funny situation. The problem we have right now is not that we don't have enough buyers. It's that we don't have enough sellers. So I love the intent, right? The goal is always to make housing affordable for those who can't afford to, and try to... The government seems to always be looking, we talk about this all the time, even with our rentals, like there's a lot of different plans out there to try to create more affordable housing so that everyone has the opportunity to buy a home, which is exactly what should be happening. The challenge right now is the interest rates are still in the high 6s for everybody else. So there's no incentive for a seller to move right now.
I've been a proponent of crazy idea. What if the government implemented a similar deal that you got when you bought your house for sellers?
That's
if
what I
you
was thinking.
sell your house, you get $10,000.
Or what if you sell your house and we'll make up a difference in mortgage rates for the first couple of years? Like,
they'll 2-1 buy down.
Government buy down.
Just go more into debt. Modern monetary theory.
I mean, there's something to be said for the problem is the gap right now is so significant. So if the sellers don't come to the market, creating more affordability, quote unquote, for buyers, to AJ's point, all it's going to do is you're going to say, well, I got $100 more to play with, which means that my price range goes up, which means that I can spend more on the front end, which means that my payment may be in the same spot when it's all said and done, and prices have also gone up in the market. So you haven't solved the net problem, which is we have an imbalance of too many buyers and not enough sellers. And now you're just creating more buyers and you still have not enough sellers.
Well, truthfully, if this is 0.3, I mean, $99, what does that afford you on $400,000? Is it $20,000? Let's just say it's $20,000. It's an
probably
easy
more
number.
than that. Even.
It might be, but let's just say it's 20. Okay, $20,000 on $400,000 is 5% forced appreciation.
Yep.
That's pretty wild. That's more than a year of appreciation.
The only way I can see this playing out positively for the overall market is if prices keep going up, then sellers may say, well, forget it, I'll just buy, right? But if then they're buying at a higher price, they end up in the same problem.
So
they have to
imbalanced.
buy a house.
Yes, but the buyer pool of who that's affecting is probably going to be at lower price points. So if you're a move-up buyer, the higher price points may not appreciate, but the lower price points may, in a way that might make it make sense.
But what we're seeing, but to that point, so I want to do a social post on this week, I think, but and this is kind of off topic, but not really, because it relates to the market. So the simplest terms I can put it in of the problem we have is we don't have enough net positive sellers. So what the situation you're describing is actually a net negative to the market, because you have a first-time buyer buying a move-up buyer's home. Mm-hmm. So we have 2 buyers and we have 1 seller. Well, technically we have 2 sellers. 2 buyers, 2 sellers, right? But eventually at the end of the chain,
you have 3 buyers.
Maybe. Then you have another seller in the back end. So at the end of the day, you need to have at the end of each one of these daisy chains of transactions, you have to have a seller that's not buying a house in our marketplace.
Or buying a new construction house.
Yeah. Well, you need more new construction.
Builders.
Mm-hmm. Yeah. So you need these new construction. You need landlords that are going to sell.
Yep.
You need people who die and their house goes into an estate.
Yep.
You need sellers who are moving into assisted living, or you need people to leave the market. Or you need people to sell and go and rent. There's 6 profiles that give us a net positive.
You want to hear one that the people are going to hate? Incentivizing non-owner occupant housing to sell their house.
It would make a huge difference. I mean, we saw that
they're
Minnesota
+1 then.
Yeah, we saw the Minnesota legislation that they're trying to that we talked about this week, where they're trying to make it so you can't buy. Institutional buyers just can't buy in our market. Think about what would Open Door do in that situation? They're not turning into rentals, so maybe it doesn't count.
I don't think that would count.
Okay,
it's more about it's to your point. They're trying to solve this.
They're worried about the hold. They're worried about
they're right though, because what were the numbers? They've more than doubled in the last 5 years in terms of the percentage of
but now
homes that are being held.
They should have been doing something while this was all going on, and now they might be in a bit of a hole they can't dig themselves out of, is what it feels like.
We talk about this, right? The massive swings that we've seen on everything in the world since COVID happened, but interest rates go to basically 0, and then now they're at 6.5. You just create these adverse impacts that you don't anticipate when these types of changes happen.
I saw a stat yesterday that said 99% of the people who own a house in the U.S. have a lower interest rate than the current market interest rate.
Yeah, it makes
Everybody but the people buying a house right now.
It's insane.
Or those that bought, what is it, 3 months ago?
Yeah.
That's why when everyone says, well, there's going to be a big refi boom in a year when the rates go down, I'm like, well, not really. There's not that many people that there's going to be that are going to refi. They don't.
No.
It's only the sales that happened.
It depends on how long this time frame goes on for, and then how far they drop.
Exactly.
Yep.
If it lasted for 5 years, then it'd be different. But it's only been going on for 6 months.
If it stays at 6, if it stays in the 6s for another year and then it drops into the low 5s, you'll see all those people refi out in 2 years.
Not that many people.
No, there aren't that many.
One more off-topic point here before we get to the script of the week. Did I tell you guys I have a showing on Thursday in Richfield? 31 showings on Thursday.
In one day?
On the same house.
What's the price?
300s.
That's crazy.
I think I mentioned to you guys.
We sight unseen offered way over, and they just said no.
Oh my gosh.
Really?
Yeah.
I told you guys I had a house that I saw in a suburb near city where we live, and I did not like the house. I told 2 different clients I didn't like it. I had the second one, I was like, I really don't like this house, guys, and they were still almost wanting to buy it, and I had to.
There were ghosts in the house.
I was like, I had to convince them this is a bad purchase, this is not good, and they got 6 offers, and they got a price where I'm like, it's never gonna sell for that.
Yep.
There's
You're
no other
stuck.
houses.
You're just stuck.
So if you're listening and you go back 4 months ago when we were talking about getting out there when no one else is out shopping, rewind and listen to that episode and actually trust us when we say to get your butt out there and buy before the market gets crazy.
I am going to, in 2023, make sure every single one of my buyers who have mentioned buying in the next year and a half, that I'm going to make sure they know that. Because it was worse this year, though, in my opinion, than it
was
has
so
in the past.
slow.
But it was also because it was rates are high and there's not that many houses. And so, what will the new year bring? Maybe it's not going to be that competitive. Apparently, it does not matter. The second January 1 hits, nothing matters.
My New Year's resolution is to buy a house this year. That's what seems to happen.
Yeah, every year.
I quit in August and then in January. My New Year's resolution is to buy a house this year on the 1st of January.
It's crazy.
It's wild.
It's wild. Okay, script of the week. Let's just say we're playing basketball or playing pickup in the morning, and you did hear one of your buddies looks at you and goes, "Hey, I'm thinking about buying a house." I actually chatted with a lender, and he He brought up my different loan options, but said FHA maybe didn't make any sense. What's your response?
I would say, what did he say did make sense?
Conventional, probably.
Yeah, I mean, typically in the past, we've really told people conventional loans are the best product, namely because the mortgage insurance can fall off after you get to 20% equity. So you can even get a new appraisal if you fix your house up and get rid of your that mortgage insurance monthly premium, which on FHA, it's for the life of the loan. But FHA recently implemented some new loan level mortgage insurance adjustments, and you're seeing some savings that's at certain price points over $1,000 a year. And so what I think would be best is if you had them run the numbers side by side and figure out which monthly payment is lower or which ones, like, how are they differing? And if the FHA one is a little bit lower, then just factoring in, are you planning to fix the house up? Are you planning to live there for a long time? And then just giving some sort of kicker for the fact that you can get rid of it on conventional. Because with the new adjustments and depending on your credit score, it could be a better deal now to do FHA.
And with rates being high right now, if down the road you're able to get to 20% equity, you can always reevaluate and refinance into a conventional loan in the future. So it doesn't limit your ability to do this as long as you would qualify for both right now. Maybe save some money on the front end, and then if rates do go down in the future, just evaluate whether or not it makes sense to refi once you get to the 20%, so that MIP that is supposedly lives for the life of the loan, in theory, then wouldn't have to.
That's a great point.
Love that. I just want to make sure I point out again to the listeners, the reason for the script of the week is not necessarily to be out there convincing people, let's just say, to get FHA loans over conventional. It's to make sure that you can show the people around you that you know more than they do and more than other agents, because nobody else is going to say that to them. And so you instantly become the trustworthy agent in the room and the expert.
Be better.
And that's all we have today on the Nerdy Agent Podcast. We will see you next week. And remember, be better.